Hello everyone, a warm welcome to all of you. I'm Laetitia Cochard, I'm a program director at HEC Paris, and on behalf of the board of HEC, of the faculty, and of all our teams here, we hope that you're all keeping well during those very complicated and unprecedented times. At HEC Paris, as an academic institution, we believe that the current situation lends itself to reflection, and that the best way to support you is to share the analysis by our professors. Today, the presentation will last about 30 minutes and will be followed by a 50-minute question and answer session. There are many of you today here on Zoom or on YouTube, and we'd like to thank you for this. We'll do our best to respond to your questions. Today with us is Tomasz Michalski, Associate Professor of Economics and Decision Sciences at HEC Paris. And Tomasz, this afternoon, you are going to speak to us about dealing with sovereign default. So Tomasz, the floor is yours. Thank you.
Hello, everyone. Thank you for tuning in to our webinar. My name is Tomasz Michalski. I am Associate Professor at the Economics Department. I am a researcher and an economist, and I am dealing with international economics in my research and teaching. So what I would like to share with you today here is some of my remarks about dealing with sovereign default, a topic that is particularly pertinent for Lebanon this year. Just to things before we start, first of all, I'm from Poland, and my country had defaulted on debt in 1989. We had a 1990s we had restructurings of sovereign debt, and for these restructurings proved to be very successful. At the same time, Argentina had similar restructurings, and the two histories of the countries diverged in the next 30 years. So what I would like to do is how to deal with sovereign debt default, what happens next, and explore from my perspective, for what it's worth, paths forward for Lebanon. So this is going to be short. My remarks are going to be really based on existing research. I will welcome questions, particularly afterwards during our Q&A session. So here's the plan of my talk today. My brief talk. First, I'm going to talk a little bit about the sovereign debt dynamics. What happens with sovereign debt? When are we going to get, in the end, sovereign default? What does that mean? And then what happens in the aftermath of the default, right? So we have restructurings. And then what I would like to divulge a little bit on is about structural reforms that might be applied in the case of Lebanon. So let's start. Let me talk first about the sovereign debt dynamics. So, first let's start with the purposes of sovereign borrowing to understand a little bit better what is this serving. So first, we could say that it serves for consumption purposes, consumption of the government, in particular financing budget deficits. First, it can be super technical. It can be just about the liquidity of the budget flows, the tax receipts and expenditures are not matched. But then, in a year like we have now, where many governments, for example, in Europe, they use borrowing to provide Keynesian demand stimuli on the way. And then there are many other things that sovereign debt borrowing can serve, for example, to fund large investment projects where the market may not be particularly keen on locking in funds for several years. It could be about intermediating funds to the private sector via, for example, state banks, providing a liquid benchmark for the entire economy, etc. But clearly, it shouldn't be about borrowing to repay old creditors, right? This would bring you on a spiral to default. So having established what we're talking about, right, about why we have sovereign borrowing, let's talk about what are the manageable debt burdens that can be sustained for a longer period of time, right? So the first observation that we should make is that if you have a debt burden that seems manageable, given that you have the current tax revenues, the growth projections, the market interest rates, for any country, in particular for emerging economies like Lebanon, they may become this public burden may become too high if any of these change radically, and they can move quite vehemently. In fact, this saved burden based on historical data depends very closely on countries' history of default and inflation. So I have some data from Reinhard Rogoff's book from 2008. This data is particularly interesting. So based on 1970 to 2008 defaults, countries that were defaulting on particularly external debt, because that's the most frequent one, had GDP ratios of 69% to gross national product, and around 229% of debt to exports. And what was observed that after having 30 to 35% of external debt to GDP, the chance of default by a country increased significantly. But in fact, this focus on debt burdens necessarily is not necessarily the correct one. We should actually focus more on the interest rate burdens as well, right? So here I have a map from the IMF for 2011, because that's when we had data for the last time. So what you see here is the gross government debt, so both external and internal. And you see that's particularly at that year, you had several countries in Western Europe or the US that were most indebted. So they had debt to GDP levels of above 75%. Now, that per se may not matter much, because what matters is how much you pay for your debt. And if you move to the interest rate paid as a fraction of GDP, you can clearly see that it's actually the emerging countries like Brazil, Egypt, India, to some extent, Greece, right, that are the ones that are paying most in terms of debt to GDP. So let me scroll back and forth to just convince you that, the West European countries and their North American, South Japan, these countries are heavily indebted, but since they pay very little on their debt, they don't have a significant debt burden. Now, let me talk a little bit about the debt dynamics. This can be about external debt dynamics or domestic debt dynamics, and it's about the public and private debt. So how will we look at the evolution of debt through time? So what is the change in debt, for example, on a year-to-year basis? Well, it's very easy, right? It's the interest payments that you have to pay, right? That's interest times the debt stock, plus any additional fresh borrowing that you're particularly having, right? So if, for example, in the case of external debt dynamics, if from a perspective in the entire country, your investment is higher than your savings rate, you're borrowing from the rest of the world, even if your interest payments are nil, right? So I will call this is going to be the new borrowing that you have. And then we have the savings share minus investment share of GDP. That's actually, it can be related to, in this case, to the current account. So if this evolution continues, that you have a continuous change of debt, one question that arises is, can the debt to GDP become stable, right? In such situations, right? So can I have, for example, a situation that every year I'm going to be indebted a little bit more, but overall, in the long run, I will have a stable debt to GDP ratio? And the answer is yes. You can achieve that. So, for example, if your new borrowing is going to be positive, right? So you're going to borrow, for example, for the external debt dynamics, more from the rest of the world than what you're saving, right? So you invest more than what you save. And then if you look at your growth rate, if your growth rate is higher than the interest rate, this ratio will determine the long-term debt to GDP ratio, right? So you can actually have a constant GDP ratio. But obviously, what you can decipher from this equation is that if your growth rate falls, right? If your interest rate payments start increasing, and your expenditures, borrowing increase while the savings drop, right? Clearly, this is going to blow up, right? So this is going to blow up, and you're going to have face a problem, a crisis. And this is true for external debt, but also for domestic debt as well. So let me show you a country where this happened. So this is Greece. Starting from 2000, as you may see. So what you see here is the government gross debt, that's in gray, and in black you have gross domestic product of Greece in billion of euros. So what you see is that until 2008, you actually had a stable debt to GDP ratio in Greece. But then what happens in 2008 when you have the financial crisis? Well, the growth rate falls, right? Interest rates that Greece has to pay on the financial markets increase, and their borrowings increase because you have just a financial crisis. So you want to provide a Keynesian stimulus to your economy. And as you see, the two paths diverge, and Greece enters into really big problems over here. And it finishes with a near default scenario and a restructuring of their debt in the middle of 2011, right? So what do we learn from this segment? Well, first of all, sustainable debt burdens for emerging countries can shift rapidly. It's the interest rate payments that particularly should matter. We should look at that. If we actually have an unchanged perennial borrowing from the world, low growth and high interest rates, this will lead to default. There is no escaping from that. And that's something that I'm saying obvious things here, but this is something that we should take a stance on. So then we may have an episode of debt default. The precise definition of a sovereign debt default is that a country stops servicing its debt, repudiates on all or part of it, so refuses to pay, says the debt is invalid, that's what repudiation means, or changes the repayment conditions, even mildly, but changes it unilaterally. Now, this is important because, for example, in the case of Greece, you actually didn't have a default because the creditors agreed with Greece on a restructuring, and there was no default, no unilateral action on the side of Greece. So there are different questions that are related with sovereign debt, right? So one thing, this is obviously when you have sovereign debt contracts, those are contracts, but implicitly is default in the contract, because if you pay high interest rates, like for example Argentina, isn't it true that it's like having an option to default, right? Argentina on average in the past 60 years defaults every 20 years. So if you calculate the returns on investing in Argentina's debt, it's just like investing in a risky security. It's just like investing in stocks, right? So perhaps when times are rough and debt default doesn't come lightly, Argentina just exercises an option, right, that everybody is aware of. And a different question that is very interesting: should the countries, because we're dealing here with sovereigns, should they honor debts that are acquired by previous corrupt governments, right? This was, for example, a statement by Ecuador when they defaulted in the late 2000s. That wasn't the debt of the people. And to some extent, given that debt was acquired by communist regimes in Eastern Europe, a lot of that debt was easily restructured by the US, the IMF, Western creditor countries, when these countries started reforms after 1989 and joined the club of democracies. A different question: can a country go bankrupt? I mean, it's not a firm. You cannot take away its assets, declare it invalid in court, right? So it's always a question about whether a country is able or willing to repay, right? Now, there are situations like in Romania in the 1980s where Nicolae Ceausescu, the dictator at the time, starved its population and tried to export as much as possible to be able to repay the debt. On the other hand, for example, a country like Bulgaria or Poland, they refused to do that, and they just said, we're not going to add to a difficult situation for our population. We're just not going to pay the wealthy creditors. And that's also what, for example, Ecuador said in 2000s. Now, obviously, you might ask at this stage, why would anybody hold sovereign debt if there's no punishment for doing so? You cannot enforce a country that to pay that doesn't want to pay. Well, it's not that easy. There are some penalties for non-repayment. So among the sanctions that are immediate, there are some direct sanctions. For example, there are attempts to seize property. For example, in case of Russia or Argentina, foreign courts try to seize assets of those countries abroad. You also have, at the micro level, such things like lower international trade or lower foreign direct investment. That is substantial, right? So, for example, Rose found that the international trade is lower by 8% per year for 15 years after default. And then you have other things that happen locally. Most importantly, there are higher borrowing costs for domestic companies. And deferred sanctions include the punishment for the state. You have reduced or no lending, exclusion from the lending market for several years, though it's not permanent. And then when you return to the market, you actually have higher borrowing costs. There's also sometimes, so most of this, for emerging markets, most of the default is in sovereign instruments, but there's also episodes where you have domestic debt default. So countries default on their home issued debt. Most recently, it happened in Russia, Ukraine, Argentina, Ecuador. This is rare. These events are much less frequent. And the reason is very simple, because it's much easier to default on sovereign holders of debt that are not your citizens. They're not your constituents. You actually are taking away from foreigners, right? There's also a different way of thinking about that default. So you could think about that it's an unprecedented wealth tax, leave it in an unconventional way on a part of the population. In particular, you might think about, if you go into thinking of the IMF on the subject, they were considering a 10% wealth tax on everybody to solve sovereign debt problems, right? So instead of defaulting on creditors, you could have a 10% wealth tax on everybody to solve all sovereign debt problems in the Eurozone. And modern thinking also thinks that, one of the way of implicit breaking of some kind of a social contract is, for example, inflating away the debt that is denominated in your home currency, right? So that's what many West European countries did, and North American countries did in the 1970s, where they had high inflation in the 1970s. So what do we learn from this? Well, first of all, the sovereign debt is an odd contract, right? It requires different kinds of, there are different kinds of considerations than when you have a firm. And here, clearly, very quickly, we see that political economy matters a lot in settling this issue, right? Whether the default will occur, right? Who will pay in case of default, whether it's foreigners, domestic holders, what assets are going to be seized, what is going to be done later on also in restructuring. So let me go to the aftermath of the default. You default, what happens then? Well, first of all, surprisingly, if you look at default on a historical basis, so for example, on this database from Reinhardt and Rogoff from 1970 to 2008, you find something that is perhaps counterintuitive. So if you look at this table, right, and you look at GDP growth year on year, prior and after the default, and average inflation year on year, prior and after the default, what you see if you look at those numbers is something amazing. So for example, consider first the case of domestic default and GDP growth, right? Prior to default, on average, so those are just correlations, those are just, means, if you will, what happened on over a large set of countries in the period. So what you see is that these countries, before defaulting on debt, they were having recessions. So they were the real GDP was declining by 1.9% a year. But what happens after a domestic debt default? Surprisingly, growth resumes. And once the economy is liberated for the debt from the debt overhang, even if the debt is not restructured, because that's not factored here in, the economy starts growing again by 2.9% on average, right? So this is this is very surprising, and the differences are statistically significant. This is a huge swing in growth, right? It's nearly 5% a year, right? The difference. The same thing, albeit at a lower scale, happens with external default. And here we just have averages. It doesn't adjust for the size of the default. But it comes at a cost, right? So it comes, you see that inflation is really, you have hyperinflation before an average, and then you have even higher inflation afterwards, right? With external default, again, that's true. So it's actually something super surprising. Defaulting seems to help a country grow again, right? At a price of having higher inflation. So of course, once you default, you may stay in default. Some countries stayed in default for a very long period of time. For example, Russia. But if you want to return to financial markets, stabilize the situation once again, you go to the negotiating table, and you potentially restructure your debt. And this is what I want to show you next. What happens to economies after restructurings? Okay. So restructurings are, in fact, indeed, are going to be important. And when you think about restructurings, one of the most important issues that you face is what is going to be the high haircut, right? If you have a high haircut, if you have a high write-off of debt, so investors, creditors suffer a lot, you will have longer exclusion from financial markets. On average, in the sample that Dias et al. Analyzed, if you had a haircut below the mean, you could return to the financial markets within 3 years. If you had a higher one in that group, it was 8 years. So a high write-off is going to affect when you can return to financial markets. And then when you return, the higher your haircut is, the higher the rate that you pay on your debt. So that increases your debt otherwise by 120 plus basis points 4 or 5 years after default. after a 40% net present value haircut. So that's research by Kuchis and Trebesh from 2013. So those are the effects, negative effects of high write-offs. But if you have a high write-off for highly indebted countries, these high write-offs may be actually the thing that you need to restart growth. And in particular, this is going to reduce future payments, implicit taxes on domestic investment, and this is going to help you with growing again. So let me show you some things that happen to countries after restructurings that are with creditors. So the restructuring date is going to be T, and then we're looking at years T+5 and T-5. And you had two samples. We have two groups. One are advanced economies based on data from before the Second World War, in the middle of the 30s, and then 30 middle to high income emerging markets between 1978 and 2010. So for example, Poland, Argentina are here inside. Amazingly, what we find is in both cases after restructuring, GDP of those countries increases in 5 years to come. So overall, at a minimum for the sample of emerging markets, GDP increased in the year +5. It was higher by 10% relative to the year of restructuring, right? And this is the year of restructuring, not necessarily default. Well, how about debt service? Well, debt service is stabilized, right? So it's still pretty high at 6% of debt to GDP, right? That's nowhere near Western European or North American standards, but it's lower than just in the periods before restructuring, where it could cover around 8% of GDP. How about the average debt to GDP? Well, obviously, when you have a restructuring, your debt shrinks, so we shouldn't be surprised. But by how much? So in T+5, you're in the sample of middle to high income emerging markets, you're at something like 55% relative to around 75-80% prior to restructuring earlier. Then, what happens when a restructuring takes place? Well, in the year just before the announcement, actually investment in the economy increases, right? And this is what really delivers this growth boost in those countries. Here you have a sample of so-called Brady countries, that how their investment was increasing. Of course, their investment was lower. This is the left-hand side than of a group of control countries, but the increase is important after the restructuring, right? So this is new investment. You restructure, you increase investment, and that delivers higher growth. Now, what is also important is that you're going to have reforms that are going to accompany this, and then you're probably going to be more successful. So here, what you have is stock market performance among the so-called Brady bond restructuring countries, and the black line that you have over here is for Brady reformers. The thin line is for non-reformers. And this is the stock market performance in months, okay? This is before the announcement. So prior to the announcement, the stock market increases, but in countries where you have no reforms after the restructuring, this market rally actually dies off, right? Because perhaps there is a problem with delivering long-term growth, right? So this comes to this question, how to be successful after a default. Well, you need to restructure. You need to probably have a high haircut, and you have to reform. Without reforms, it's not going to probably work, right? So what is going to be a successful restructuring? It can be it could be about debt sustainability, so the ability to just repay debt. But in fact, if your goal is to establish growth, you need to have higher haircuts. And this is going to reduce the debt overhang problem, especially in an economy like Lebanon, where now the debt to GDP is skyrocketing, given the shrinking economy as well. One case in point and a big source of data for also what we're going to talk about are so-called Brady Restructurings that occurred in the 1980s and 1990s, and several countries participated. They were particularly successful. So they were focused on long-term debt relief. The haircuts were substantial, 30 to 50%. And the interesting part about this was that creditors could pick from different options from a menu that were offered by the debtors. And repayments were extended well into the future. So there were many countries that participated in this round, including Latin American, Eastern European countries. And among the sample, you had Poland or Argentina, right? And those countries that pursued reforms turned out to be successful in the long run. And those that did not, well, they failed into this debt spiral. So what do we learn from this? On average, after default, growth resumes at a price of hyperinflation, right? So that's a pain. And again, I want to stress, this is on average. Perhaps that's not what's going to happen to Lebanon, given the odd and weird year that we have now in 2020 with the COVID epidemic. And then we're actually also restructuring is very important, and the accompanying reforms as well, right? Now, the good news is that the IMF, with the organization with which Lebanon is going to negotiate, also knows this. Guess what? The graphs that were done over here, they were prepared, and all this research by a lot of the IMF researchers. So they know that there is a carrot hanging out there. They know that on average it works. On average, again, right? Doesn't mean it works always. On average, it works. So let's go to the structural reforms, because obviously that's going to be a part of the package of the IMF, right? What happened in Lebanon prior to 2020, right? There was, I would call this a twin deficits problem, and there was a high persistent, and you could call it structural public sector deficit. With you're probably going to be much better in reciting all the problems that this entails. And then also accompanied by a high persistent and structural current account deficit. So if you want to have a successful plan forward, you need to deal with both of those issues, right? So in a small open economy, one is going to typically, for example, a public sector deficit is typically, not always, but typically is going to translate into a current account deficit. But you can also work on the current account deficit only. And this is, given my specialization, this is what I will want to talk about, especially that here you can abstract a little bit from a lot of the political economy issues that are always a problem in each country, but may be very specific to Lebanon. So first of all, IMF obviously is going to require reforms coupled with its financial package. They might act. They're going to have a goal of both reducing both twin deficits. They're going to focus particularly on short-term stabilization. But the IMF evolves, so they understand nowadays that there's a need for a social safety net. They're no longer so ideological, if you would put it, requiring markets, believing that markets will work as in the 1990s to solve all the problems. They're no longer, I could say, naive in that matter. But still, let me stress, given this, the long-term resolution of the twin deficits is really important. And let me concentrate on this current account deficit, right? So this is Lebanon 2019, the last normal year. And here you have the current account deficit in millions of US dollars, right? So let me look at this, right? So first of all, there's a deficit in the goods section. Basically, imports are very low compared to exports are very low compared to imports, and particularly, the exports are particularly puny for a small open economy, right? It's less than 10% of GDP. Now, on the services side, you have a more balanced. It's more balanced. It's actually, there's a little bit of a surplus. Then there is a lot of income that is flowing out of Lebanon, for example, in interest payments, capital dividends, and so on. And then there are a lot of flows in terms of, for example, remittances from the diaspora back home, right? So can you have actually such a structure of a current account for a long period of time? Yes, if you don't have the deficit. Okay, so if the deficit will be zero, there will be no problem. The fact that you don't export a lot of goods, that's not a problem at all. The reason is that nowadays anyway, manufacturing is not an important part of GDP in any advanced economy. It's something like 10 to 15% in many advanced economies. What is king is services, right? So if I look at a current account like this, the only problem is that the imbalance is too huge and it needs to be corrected. How can it be corrected? For example, by various measures that I will suggest next, right? So there's one of the issues, obviously, that you can do is to liberalize the exchange rate market, the exchange rate, unify the exchange rates, and let it float. And that's going to be obviously that may be a problem in the short run, because you're going to see a huge devaluation or depreciation when it's floating of the Lebanese pound, but you cannot continue like you did in the past. This by itself is going to restore a lot of this balance, because suddenly imports are going to become more costly. It's going to be much services and goods from Lebanon are going to become much more competitive in the world markets. So further reforms are going to help. So first, what I would call breaking the original sin problem. So here it will be the capital market liberalization, exchange market rate reform, banking sector reform. Let me tell you shortly what the original sin problem is. If capital markets, as is the case in Lebanon now, are segmented, the rates of return differ from what you have in the world market. And then domestic interest rates are high, and banks, firms, households, the government, everybody wants to import capital and in fact borrow in foreign currencies. And that's the problem of the original sin. So if you actually do various capital market reforms, you can lower the cost of capital. And this is what you see in this graph. The blue line shows after a liberalization that the cost of capital measured by equity to price ratio declines significantly from the prior years in reforming countries. So that's number one. Second, so that will help, for example, on lowering this problem over here, right? Balance on primary income in the longer term. And then another thing is trade liberalization, right? So this trade liberalization will help Lebanon to increase its exports, and not necessarily of goods. It can be purely of services. So how can you do that? Well, first of all, join the WTO. Now, I understand you have free trade agreements with the EU, but that's not enough, right? You're still suffering high tariffs on your exports in the world markets, and you want to avoid that, right? So WTO membership will help. Using the strategic geographical location of Lebanon is going to be important as well. And I'm going to make a point on why I believe Polish and Argentinian ways differed exactly because of geography and using the strategical position. So Lebanon has a bridge between the Middle East and Europe, but again, you need to be open, right? You need to open up your trade. When you stabilize the economy, you lower the deficits, you stabilize exchange rate fluctuations. If you're able to do this, you liberalize trade, and you guess what is going to happen? International firms are going to come and take Lebanon into their global value chains, right? And it doesn't mean that you're going to produce very low upstream goods. It's actually what you're going to get is probably, given the level of education, you're going to specialize in the middle or the top of the production chain, right? Also, what is an asset is Beirut, that it's a large, diverse city that can capitalize on agglomeration effects, as we call it in economics. And that's still, despite 40 years of carnage, remains a large, important city, and it can still be flourishing in, say, 10 years to come. So all these measures are going to uncover the comparative advantage of Lebanon, at least regionally, in high value-added sector. Well, financial services, that's obvious, but also healthcare, education, media advertising, artisans, and that's going to help you resolving the current account deficit. Let me show you how growth resumes in a sample of countries after trade liberalizations, right? Relative to a control group. So trade liberalizations are important factor that can pull you up after these episodes of the default. So let me talk in my last remaining minutes of my remarks about the differences between Argentina and Eastern Europe, right? The big difference is that it boils down basically to geography. Argentina is so far away that you cannot be a part of a value chain, right? It takes very long to ship anything to Argentina back and forth to major markets. So the benefits of trade integration are far greater, for example, for Eastern Europe, right? And they had a higher incentive to do so, to reform, pursue globalization. Guess what? Lebanon can follow the same scenario, right? Potentially with a little bit of luck and liberalization and reforms. So here you have exports as a percentage of GDP. I would like to concentrate on prior to 2004. The black line is Argentina. Here they have a default and they have a growth because of sudden depreciation of the peso. So this is also, they increased their growth rate, the trade because of that. But in the longer term, trade to GDP, exports to GDP remained at a long-term level that was pretty low, 10% of GDP. Whereas for Eastern Europe, you have a growing trend. So here you have 4 countries that defaulted and restructured their debt at the same time as Argentina around 1990. Here is the participation of those countries in global value chains. This is the share of the domestic value added in exports, meaning that the rest are imports that are embodied in exports. The lower this ratio is, the more you're integrated in global value chains. So we see that Argentina is actually less and less integrated with time, whereas here these countries are very well integrated already in 2005, and their integration typically grows or stays the same in the years that follow. And here you have export as a percentage of GDP, value added. Again, a huge increase for the Eastern European countries that restructured the debt, reformed, opened up to trade, benefited from integration with the EU, and Argentina that basically went back to their long-term low participation in global value chain. These are all the remarks that I wanted to discuss today. I'm welcoming your questions. The bottom line, obviously, of my talk is dealing with sovereign debt is not easy. There are clearly different paths forward for Lebanon. One, there's a very optimistic scenario where you could go the way of Eastern Europe. And then there is a pessimistic scenario that of Argentina. For example, after 2001, they still remained in the doom loop of defaults, and they haven't progressed much from then. Thank you very much. I'm waiting for your questions.
Wow, thank you very, very much, Tomasz. That was fascinating, and I think it gave many valuable insights for our participants today. So there are a couple of questions in the chat. I'm first going to ask Nicolas Boucater if he's got questions to ask you.
Yes, hello, Tomasz. This was very technical and very insightful at the same time. Thank you. I hope we'll follow the Argentinian, the Eastern European countries model and not the Argentinian one. At the moment, we hope that the negotiation with the IMF will start again soon. And with that in mind, I have three questions, quick questions. The first is, according to our readings and what you just said earlier, IMF have evolved in the way they approach a sovereign default over time, and austerity plans is not anymore a norm. So my question to you is the IMF stance on social safety nets. Will they be imposing social safety nets in the plan, or would they leave it up to the Lebanese counterpart? This is the first question. The second one, will the IMF impose in this plan to reestablish a trade balance, exports, imports, equal imports, and during the negotiation? And the third one would be, if you can explain what is the governance model of the IMF and how the IMF takes a final decision and who is voting?
Okay, so let me deal with some of those questions rapidly. So first of all, the IMF recognizes by now that reforms need to have social backing. So I'm not saying that you will not have any austerity measures. Probably there will be some, but you need to have a minimum of a social safety net to be able to implement those reforms. Because we can, as we said before, you can try to be like Nicolae Ceausescu of Romania and starve the population. But in fact, that's not possible in a democratic society, right? But so you need to have a minimum of social peace and social agreement, social contract that is going to allow for the reforms to pass. So that's number one. Second of all, will the IMF try to impose trade balance? Definitely, they're going to talk about exchange rate reforms and the need to deal with the really terrible current account deficit. I mean, you cannot progress without repairing this in the following years. So reducing, in particular, the reliance on borrowing and borrowed capital to import a lot of goods. So by itself, if you look at exchange rate, we're looking at, if you look at the exchange rate devaluation that may happen, it's very easy just to compare the official rate that you have now with the black market rate, right? And probably the true rate is going to be closer to the black market rate than the official one, at least in the short run. Then is going to appreciate a little bit more. But that by itself is going to be a big correcting mechanism. So then the question is going to be, how to, what is possible, how is it possible to increase exports, right, in particular? So how is it going to be possible to increase the exports of services, exports of goods, right? how this will react. And probably Lebanon's strength is in services. Now, about the governance of the IMF, I have very little to say here, and this may depend heavily on how different countries that are main shareholders of the IMF are going to react. So this is a matter of, I would say, even diplomacy, and I will have very little to say about this. So I will abstain from that. Okay.
Yes,
thank you, Tomasz.
Thank you. So I have a question here from Joe in the chat box. So he's asking, what would be your advice to executives and entrepreneurs who are facing the Lebanese default, maybe on a short-term and a medium-term advice?
So first of all, for sure, what's going to happen is you're going to have a huge exchange rate adjustment in the next 2-3 years to come. So you need to, whatever your business is, you need to plan ahead for that, and you also may want to prepare. So what you're going to see is that your products, are going to be much more competitive in the rest of the world. So I would seize that as an opportunity. You should also prepare for 3-5 years of exclusion for the market from lending at normal rates. So the next 5 years is going to be particularly touchy. If you can secure foreign lending at attractive rates, you got to do it now. Don't hesitate. There are many things that we could talk about. So I guess we should be more precise, topical about this. But definitely the next until the restructuring, you're going to have a huge maelstrom of various things that are going to arrive to the economy. One thing that is going to be true, for sure, you're going to have inflation. Now, whether you're going to get this growth boost, I wouldn't be so certain given the external circumstances of COVID-19 and the fact that the external situation of your neighbors is not really great either.
Thank you, Tomasz. Do you have time for a final question?
Please do. Please select some from the chat or Q&As. Let me know.
Okay, so the final question is from Antoine, and he's asking about Greece. Why didn't Greece go all the way to default if it is proved that default stimulates growth? Is it because the inflation leverage was not possible? What is your insight on this?
So, first of all, Greece didn't go all the way to default for some technical reasons. Basically, the creditors didn't want to have a defaulted paper. For example, banks didn't want to have assets that a country defaulted on. But in fact, if you look at this graph, what Greece effectively got, they had a debt reduction that was very stark, right? So in a sense, you could say that they did default without officially defaulting, in the sense that they changed their repayment conditions unilaterally. But a crisis, a sovereign debt crisis, was there. And as you see, Greece in the following years, it's not that their economy really recovered, right? So potentially, Antoine, is up to something. Inflation really liberates a lot of things as well, because inflation changes a lot of relative prices in those economies, right? So that wasn't possible clearly in the Greek case. But Greece did default, without officially defaulting, right? And they had a restructuring.
Thank you for this answer. It's fantastic. So I think we've now reached the end of our webinar. I'm going to let Carolina close this session. Thank you, Tomasz.
Thank you very much.
Thanks to everyone. HEC Paris would like to thank you for taking part in this conference, and we hope you can join us for our other webinars. The next one and final one will take place on November the 5th at 5 p.m. Central European Time with Lauren Marouani and Henry Gost on monetary marketing and financial initiatives for growth and recovery in 2001, application in Lebanon. Until then, keep well.